Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of May 4th, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at earnings because it is earnings season. And last week was probably the busiest week of earnings, and then this past week was probably the second most busiest. And I am back in full earnings swing, and Viper has started to dabble in earnings, and we are going to talk a little bit about how you can take earnings season and kind of tilt the probability of profit in your favor so that you have a more likely chance of coming home with a win when it comes to earnings and options. And we're going to talk about some of the mechanics behind what is going to happen to those options as you go into earnings. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. Viper, I am back in action this week. So last week we really talked about, being an ant or a grasshopper. And the week before that, we really talked about maybe the winningest move is the move there. You just don't make a move at all and you wait on the sidelines. And I know when we were talking last week in the ant and the grasshopper episode, I really started to kind of tell you, I'm really feeling like the dust is starting to settle a little bit in the volatility. I mean, we're no longer swinging 3-4% a day. We might be around, 0.5%, 1%, 1.5%. So still a lot of movement out there, but I really feel it's starting to kind of come down in tameness to the point where I was getting a little bit more comfortable to venture out there in the waves and see what I might be able to ride as far as earnings season. I mean, as you know, earnings are just one of those things that's so much fun for me to play, probably because I have a short attention span and I love my option trades and I kind of like them to go out, rinse and repeat. And earnings is one of the biggest accelerators of that because, as we've always talked on this show, earnings are a binary event. And a lot of times those binary events really accelerate price action. And I know this particular earnings season, I don't know what it was out there, but somebody has lured you out into the waters of earnings. And I believe you've kind of taken a stab at some earnings trades. And I'd like to kind of zero in on one of those earnings trades in this episode, maybe talk about, what you're approaching, the mechanics of it. And then I'll kind of counterbalance some of that point or what we learned there with how it relates to the earning strategy that I have been kind of engaged in for a long time now. And when I think back, I'm like, dang, that's been a long time. But it's been a strategy that has been quite profitable for me on a probability standpoint, the probability of turning a profit. So Viper, how are you finding the waters these days with this round of earnings?
I'd call it warming up. And so, yeah, like you mentioned, new-ish territory for me. And just a high level how we got to this point. I've mentioned it multiple times on previous episodes as far as like wanting to be more in options, but struggling to have that entry point, struggling to know how to get in. And I started to realize within the last, I'd say, month that this has kind of been going on, that one of the friction points to making that entry was the fact that, obviously hearing a lot of your strategies and things like that. And what I'm about to say certainly doesn't apply to all your strategies, but because we talk about it all the time on the show, whether it's the covered call or the naked put as a paid limit order, we also have talked about how there's an implication of capital consumption with both of those, with the covered call, with the naked put. The naked put, it's a paid limit order, so you need to have the cash secured to cover that. The covered call, you have 100 shares of that thing. So that's a large, potentially large cash commitment to it. And I think in hindsight, that was part of where I struggled with getting in, was just that feeling of I don't want to say capital inefficiency, but just not my style of capital usage. Um, and so that was part of the problem. There's probably more to expand on that, but that's at a high level gist of just this idea that a lot of what I was looking at was very capital intensive. And so rewind a month, whatever it was, we've talked about it a couple times on the show, when I started getting into buying options, and that was sort of an aha moment for me of that is the yin to your yang of, as much as you like to be on the selling side, the buying side is still to this day, even though I've gotten burnt several times for reasons that I kind of started to get into when we talked about it, but that it's more relatable to me, taking a very small amount of capital, throwing it on the line, writing it off as this is maximum loss right up front. And big things could come from it, or it's maximum loss right up front. I've already separated with that. I can take the position and then push it off to the side and go focus on more things. And so that sort of compartmentalization in my trading mentality. So getting into those options buying with price action swings and stuff kind of got me really warming up to like, okay, now I'm starting to get a little bit of a thing going with options. So then that led to earnings season of like, okay, how can I parlay this into an earnings play? Because like you just mentioned, the short attention span is fantastic with earnings. Like, even if I'm buying options, there's still a potential. I mean, there is an expiration date, but there is still a potential window of uncertainty of like, okay, this thing's up really big. Do I wait? Do I sell? Do I or do I wait for the move to happen when I, in the direction that I bought or whatever? So, so started to get into earnings of like, hey, if I can find a strategy here, that allows me to partake in this seemingly overnight or day or two event, that sounds pretty exciting. And then again, going into that mentality of how do I keep this so contained, because I just felt the experience of buying options as that was really attractive to me, as far as just containing that loss right up front, writing it off in my mind right away. And that sort of led me, well, it didn't lead me to it. It was kind of, two things coming together. And this, as a tangent shameless plug, this came to me just by doing what we say what we say is so important to anybody getting into trading. Consume information, consume YouTube videos. It was just happened to be a YouTube video that was talking about a particular option strategy, which was the calendar spread. Just doing my thing, cruising around videos, and watch that. And I was like, hey, it actually kind of fits the bill. It has a very specific function. It has a fully known risk profile right up front. You pay for it. I do debit spreads, so that means I take a debit right up front. I pay for the thing, and then we kind of watch it go. So that was essentially what brought me here. And the calendar spread, I think we talked about it a little bit, but the general mechanic of it is going into an earnings, instead of changing your strike price, which is other spreads where you use the same expiration date and you change your strike price to create a spread, you're actually creating a horizontal spread where you're using the same exact strike price and you're using two different expiration dates. The reason you're doing that is the first expiration date is super close to the earnings event, as close as you can get it, and then the second one is 30 to 45 days away. And the reason for that is you want to, the reason that I started doing it, and we can discuss some additional reasons, but the reason I started doing it was because that first one, as Sprocket talks about all the time with his selling, he likes to sell these events because the volatility is so high, the pricing premium is elevated as well. But like I said, there's a big margin requirement or capital consumption that can sometimes go into some of those strategies. So what you're doing here with the horizontal spread is you're selling right up front. So you're selling that juicy one. You're buying one later on, which is further out in time, which means it is much more distant from the impact of the pricing volatility. And so you're trying to capture this pricing imbalance where the front month is overpriced relative to how the back month is priced. And so that really resonated for me. And you like I said, I do this as a debit. So I get the price up front. It says, hey, it's 50 cents to open this. I say, great, give me however many fit my particular play sizing, position sizing budget. And then the whole play is to try to capture that volatility pricing on the front, juicy premium. And then I'm holding the position in check of sorts with that buy on the backside. And in this case, the in check that I'm referring to is that requirement, that capital requirement, because it is to some degree it's covered. What I sold is covered by what I bought, so I can really focus on capturing that juicy premium there. So that's where I'm at. And I don't think you had ever been quite down the calendar spread, but did I capture that, or is there some other
No,
angle
I think
to this
you,
I
you
should
kind
be
of called it out
considering?
there. Let's. I thought maybe if we talk a little bit about a specific example, it might help with that kind of push pull that you're talking about. So I think before the show we were talking about your trade on Snap. I think was the earnings that you played, and I think the strike was $9 if I'm not mistaken. So let's just talk a little bit. Your
Correct.
front month was this Friday, or this past Friday, May 2nd, and then your longer dated one I think was like June 6th. So you sold the put expiring shorter term, and you bought the put expiring longer term. So let's just talk through real briefly on why that requires so little capital. So mechanically, what you have done is you have signed up to say, hey, before Friday, May 2nd, I will buy 100 shares of Snap if you assign me. Okay. So you might think, well, do I have to have the money to buy 100 shares? And the answer is no, because your other option gives you the right to put 100 shares to somebody else for $9. And they basically kind of cancel each other out. So if somebody were to assign you 100 shares, you would get those 100 shares, but you have a coupon that allows you to push those shares to somebody else for $9, right? And so that's why your broker doesn't need to collect anything from you, because they know that you have a get out of jail free coupon, for lack of a better term, where even if you get assigned, you now have the right to put those shares to somebody else. And because you did it at the same price, it's a net wash of zero.
Yeah. And that, just to drive the point, going back to talking about naked plays and things like that, that covers that liability where I'm on the hook should somebody assign me. If the underlying's cheap enough and I have the cash in my account, I assume my brokerage, if I did get assigned those shares, my brokerage would just assign me those shares. And then I still have this call, like you just said, that if I'm like, hey, no, I didn't want those, like, boom, I can cancel it right out and take care of it. So not experiencing any capital tie up and letting me say, if this was 50 cents a play, 50 cents a spread, then here's my 50 cents and I'm going to go focus on everything else and go do other things.
So Viper, we have the chart, I think, that you have of Snap and kind of how it played out at earnings, because it got absolutely crushed at earnings. And I believe the put that you were trading on your calendar was way out of the money, and Snap was trading much higher than that. So let's pull up. I'm going to transition over here to your chart, and just show where you bought it and where it's sitting at today.
Yeah. So as you can see there, what the candle is going on there. So that was obviously after I did my thing. So like we said, I took the $9 put. Now, at risk of being slightly confusing, but just bear with me. I actually bought this play on April 28th. So we were back here on this trading day. If you recall, these discolorations are after hours trading. So the black sections here are during trading hours. So I actually did a put calendar spread already in the money. Because we were down here at $8.80, and this was a put that I sold at $9. So the thing that I think is important though is the fact that, okay, let's pretend. I mean, we could pretend like I did it up here when it was out of the money in $9, $9.20, whatever. If this was a naked put that I sold, regardless of where I sold it, we certainly ended up in the money. we from my $9 where I sold that put, we are now down 12% as of the recording, as of Wednesday. Who knows by Friday? So this thing got absolutely obliterated. Just an aside, it was actually spot on with the expected move, thanks to options pricing and how the market prices these moves in. So that's interesting for another discussion. But it stayed within the expected move. But so what's really cool that we kind of want to highlight here is the fact that if this was naked, I'm on the hook for $900 of shares because that's what I sold. I said, hey, somebody, if you come to me and say, I want you to buy 100 shares of Snap at $9 a share, I'm coming to you. And I said, yeah, you can come to me. So the fact that I did not do that naked means that all the way down here, this deep in the money, somebody could come to me and say that. And I would say, sure, I did sell you that right. And at the same exact time, I bought the right from somebody else to just go door to door down the street of like, all right, I'm pushing these to you now. So the main thing I wanted to focus on here was the fact that this thing got obliterated, and I don't even care. I mean, obviously it plays into my strategy a little bit, but it's certainly not that capital concern of like, crap, now I need to have $900 to cover this. No matter what this moved, that sell and buy are hold there, and keeping me from being on the hook for that call or put. So this begs the question: if this is holding itself in lockstep with each other, why the heck would somebody do this?
Yeah, so let's take a look at some of the underlyings here of what kind of is going on, at least with the option pricing. And I'll kind of call out why I think your approach could work for this if your goal is to play these with less capital tie-up than the way I do it. But I'll also kind of touch on this on why my strategy also is so probabilistically profitable. So this site's called Optionistics. I don't know. Only recently found it. But it does have kind of what I want to show when it shows the historical pricing of a particular option strike at a particular option expiration time. And so, I'll explore this a little bit later on my own, but it is going to show what I want to talk about. So what I have pulled up here is Snap for expiration of Friday, May 2nd at a $9 strike. And the blue kind of mountains, that is the value or the price of that option over time. So this starts at the beginning of April and it goes through April 30th. And the volume chart is down there in the bar charts. The red line is the volatility of this exact strike at that exact expiration. So what I want to call out here is leading up to to the earnings trade. And so the earnings trade is right here at the peak of this red. This is the day before the earnings announcement. And so here we had 250% spot volatility. And what I want to call out here is that the day after that, so this has one trading day on it after earnings, that spot volatility fell to 100%. So we went from 250% to 100%. That is a massive volatility contraction. Now, the price of that option, you can see also has fallen over time. Now, the day after earnings, that price did kind of tick up a little bit. But what I want to call out here is this price closed the day after earnings at $8. That is $1 in the money. Okay, now that's important because that is $1 of intrinsic value. So that never decays. Intrinsic value is built into the option. And it's probably really hard to see here, but right about where my cursor is the $1 marker. And so there's just this itty bitty little tip above $1. That is the actual extrinsic value of the option. So if this had stayed at above $9, that's how much value would have been left in this option, and it would have been almost zero. I want to call that out because this is something where this underlying price charged full steam at that strike. And if it stopped right at the door, this just highlights that volatility contraction, and that evaporation of price in that option is what you're fighting against when you buy options that have a lot of volatility. Okay, so pause on Viper's strategy. That is why the strategy that I play at earnings is so probabilistically profitable, because all of that volatility, all of that contraction, all of that value just goes poof, it's gone. And it's super focused and extended on that week of expiration, because that's the week of the uncertainty. So cue back in Viper's strategy, and what he's doing is he is actually selling this just like me. So we're playing the same movement of the underlying of the week of earnings. The only difference is Viper doesn't want to tie up all the capital. So he purchased a protection leg further out in time. So what he is effectively doing, and I'm going to pull up that other strike that he had in just a minute, but what he's effectively doing is he's using this premium on this shorter dated option to finance and pay for the extra volatility that's in that option that's dated further out. Because he wants that option to, one, counter the risk here, but two, maybe he's very bearish on Snap and he is playing, 4D chess where he's like, okay, Snap's going to drop, but it's not going to drop too much on the first time. So I'm going to get all my money back from this premium, and then she's going to fall even more, and I'm going to really capitalize on the value of the other put.
Which, yeah, that's totally my plan and didn't just become my plan. But I mean, along those lines, like I said, going into it, and this is still reasonable, I think. Going into it, my mind was fixed on capturing the premium pricing normalization. And I still think that's a perfectly fine angle to have on calendar spreads. However, in this particular case and what we're about to see, I'm now thinking that I am bearish on Snap, and maybe I can maneuver this into being more than I anticipated as far as profit goes. So let's take a look at what that longer dated option is.
So I switched this to June 6th. Now, there's not as much volume trading on this option, so it's not quite as pretty and it doesn't go back as much in time, but you're going to get the gist of what's happening here. And again, the blue is the price of the option and the red is the volatility. And so you can see the volatility just before earnings was probably around 100% volatility. Earnings came out, that volatility got smacked down, but look, it only went down to about 60%. So remember, the first one went from 250% to 100%, massive contraction. Here we got contraction, but not as much. The reason is because this is further out in time, and so it is less influenced by that binary event. The further away you get from that binary event, the further away from the pricing influence you get. Now, if you had bought this option like Viper did, I don't know when he bought it, but let's say he did it around here on the 28th, he probably would have paid a little more than $1 for it. And now that option that he has purchased has gone up in value to around $1.40, because while the volatility has contracted, it's true, there's still a lot of time premium and it's still $1 in the money, but basically you're looking at over 40 cents of extrinsic value. And so this is where, yes, this longer dated option had volatility due to the earnings, but it didn't have as much volatility that was going to pop because it's further away from that binary event. So what Viper was able to do is purchase this speculative option at a discount because he's using that short dated option to finance this longer dated option. So Viper, what did you sell your short dated option for?
So the short dated options were sold for 92 cents.
Now, if this option was bought for, $1 or $1.12, that means you got a 92-cent down payment on this option at $1.12, which means you probably paid $20 for the spread. And now with your short one expiring worthless, ideally, I know you're a little bit in the money, but if it did expire worthless, right, this one has gone up in value. And this is how mechanically this is working.
So it kind of, in digging into like specifically how it works, this may just be too abstract. It might not work for some people, but I feel like, when you're just swing trading or something, and you buy and then you hit a stop loss or something like that. Like, there's always this thought in the back of my mind when I'm swing trading, where I'm like, man, if only I could take the position and then like get a mulligan and then get like a do-over of like, see, I was right. So, or no, it was wrong. Never mind. I did cancel that. I didn't mean it. Just kind of a thought along those lines. Obviously that's not even a thing, in swing trading, anything, but this kind of feels like that, right? Because this is like, this is like having that fully defined risk. And so the reason I say it feels like that is because the thing blows up, whatever. I paid the debit up front. I'm not, out for any more money or anything like that. But like what we were just talking about with Snap, this is almost like that unrealistic do-over, not even do-over, but just extension of like, okay, so now that back month, the long month, is kind of way up in value comparatively speaking. So now let's take the guard. It's not really taking the guardrail off, but now we remove this cap on the front. And now all of a sudden we're opened up to house money potential on what's on the backside or something like that. So, like I said, a little abstract, but that was just kind of something that came to mind in some weird mechanical way.
I think you're looking at that the right way. And I think you're starting just to scratch a little bit on the surface of why I love options so much, is because I think they really, really do give a lot of flexibility to the particular moves and strategies you can deploy. And it is kind of like you're uncapping a thing, because when you're purchasing that option, right, that out longer dated one, you're still playing that like you would just buying straight options. You're financing it so it's a little more affordable. And you could get the financing wrong and just kind of lose, but that's the whole defined risk. But yeah, it's basically once you clear that first hurdle, now the hurdles are all out of your way, and it's just how fast can you run that 100-meter dash.
So stay tuned until June, and we'll find out.
Yeah, now you do have to be cautious of of your theta decay, right? Because that is one thing. Every time you do hold options, time is your enemy. And every day that goes by, that premium kind of ticks off from a theta decay. So I don't know what your strategy might look like if that longer dated option goes further out, as you'll be less impacted by theta decay, but there's going to be more time premium in it. So that means the less that front month is going to be able to finance your longer put. So I imagine it's a delicate trade-off between where do you put that longer dated calendar option.
Yeah, certainly. And I mean, and thinking out loud, kind of workshopping a little bit, obviously that was a very large elastic move. As of recording, there's 2 market trading days left before this short month expires. So obviously I'm going to be mostly looking forward to potential for a mean reversion a little bit, where we do kind of keep ticking up in price. We won't get into the price action, but there's been a sign of it's not a real gain yet, but the option the price did go all the way down to $7.50, and we're slowly working our way back up. So best case scenario, we work our way back up. And if we get, close to $9, but we don't get above $9, so I'm still technically on the hook come Friday. I'm quite likely to just close those out, buy those short months back at a fraction of the price. As we saw, the closer we get to $9, the more and more fractional that gets. And then from there, I'll just treat it like a number of puts that I bought that are in the money, and I'll switch into price action mode, and I'll just kind of treat them that way, where yes, the theta decay needs to be on my mind. So I'm not looking to have these into June. I'm certainly looking to get these taken care of mid-May. Kind of looking at we're not quite at that 45. We're going to be closer than that 45-day mark, but still 30 days out or 20 days out. Hopefully having this taken care of one way or the other, based on the price action, but it'll be kind of a mindset flip now that I can just go into price action mode and trade this, like I would.
So one
position.
thing that I want to call out here as you go through this week, with this out there, a couple things to note for you. Early assignment is always a thing that could happen. In my experience, early assignment is very, 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 very unlikely to happen in this particular case, because you are not way out of the money. To me, or way in the money. To me, early assignment has only really happened when you are 15, 20% in the money, like deep in the money. So I really don't think you're at risk for that. Now, if you want to push this thing to the very last day, that's the other piece that people don't really understand. You cannot, you will not, you absolutely cannot be assigned in the middle of a trading day. So you are free. Once the trading day opens, if you're not assigned, you basically get an overnight, you'd get a notification overnight if you were assigned. But if you don't get that notification, you will not be assigned until after the close. So you pretty much just feel free. You got all the rest of the week.
I got options.
So Viper, as you are really exploring the option, I want to give you a nugget of food for thought to go do some research on. And that is to control the amount of capital that you have to put into this trade. You might want to also look at what's known as an option vertical. So very similar to your strategy where it's going to be a defined maximum loss. But I do believe the probability of profit will be a little bit higher than the probability of profit on a calendar spread. And that would be, in this particular example, if you had sold that $9 strike, rather than moving to a different expiration, you stay at the same expiration and you purchase a further out of the money option. So you might buy an $8 put, or maybe you buy a $7 put, right? That's further out than the $9 that you sold. That will make your maximum tie up the width of that minus what you collected. So, for example, if you only made it $1 wide, your maximum loss will be $100 less the premium you collect. So take a look at that. That is honestly how I started a lot of my earnings trades and a lot of my premium selling when I had a very small account when I started out with $2,500, because you can define that risk in that way, and your brokerage account will let you trade that. I will caution you that there is really not a lot of management choices on the verticals. Pretty much, if the vertical is breached, that's the end. Like, there's not really much management that can be applied to that, where you still have a few different management options, I think, with a calendar spread. But I think you'll find that the probability of profit is a little bit less on the calendar spread than an option vertical can be. But that's some food for thought. So that brings us to the end of this week's episode. A little bit of a deep dive on some of the mechanics of what the heck is going on with those options when it comes to the earnings season and the earnings announcement. Like I said, that I'm very passionate about the earnings time and selling options and trading them, because I've really spent a lot of time looking at the mechanics and understanding the mechanics. And we really touched on that in this episode. And hopefully that has given you some insight into what goes on under the hood. And maybe that interests you and you want to go learn more, and that's awesome. And maybe it doesn't interest you and you say, yep, that's not for me, and you want to explore something else, which is also equally awesome. Because as we always say on the show, it is really about finding the style that's right for you and the trading strategy that fits your interests and your objectives and your comfort level. And so that's what this is all about. Viper is kind of exploring this. This might be his thing. It might not be his thing. You know, we'll find out. But really kind of talking through it. Hopefully you got some interesting information and something for you to, look more into. Happy to have you jump in the Discord, ping one of us about whatever it is you're kind of approaching. Love to talk to you. Love to hear what you're interested in. So good luck out there. Have fun. And remember, think outside the block.